Hello and a very warm welcome to the Projex Academy's Finance for Non-Financial Professionals. As you can see, this is Module 1, giving you a very brief financial overview. I'm Dave Litton, your tutor. Because of the nature of understanding finance, I've tried to keep each lesson in tiny bite-sized chunks of around 20 minutes duration, although one or two of the modules will be slightly longer. I strongly recommend that you print out the accompanying handbook and also have a pen and paper to hand, since making notes as we go will help your comprehension of the material. In addition, there are several exercises which you'll need to carry out, and although I've given you templates in the handbook, you'll find it very useful to make ad hoc notes as we go through. So let me next give you a brief overview of the course objectives. This is very much a hands-on approach, and it's important you understand that this is not a certified course to allow you to follow a financial career, but rather to allow you to gain a full understanding of the key frameworks and tools that will enhance your understanding of finance. And by the end of this course, you'll be able to build a balance sheet and a profit and loss statement from core accounting transactions. You'll be able to analyze financial statements in order to determine financial performance, either of your group, your department, or your organization. You'll be able to build a budget, and if, like me, as a project manager, this will allow you to create more realistic plans. You see, as your management expertise grows, you'll find yourself being involved with larger and more expensive endeavors, running large change programs or managing portfolios of projects. And because of the large investment of such endeavors, it's even more important that you understand the basics of finance. Indeed, as a requirement of many of the programs I've run in the past, it was expected of me each month to produce a balance sheet and at the end of each year to produce a profit and loss account to show the progress or otherwise of my programs. You better construct a business case. This is something you may be familiar with already, but the broader understanding of finance that you'll learn in my Finance for Non-Financial Professionals will allow you to build a business case with a broader understanding of the principles. You'll be able to apply costing techniques and to use that information to support business decisions. And this is a key point. You see, being able to read and interpret financial statements will allow you to make smarter business decisions, and based not on guesswork, but on realistic financial data. You'll be able to build a cost-benefit analysis and apply various investment appraisal techniques. Our Finance for Non-Financial Professionals is just ideal for managers like yourself to enhance your skills in the current very competitive business environment. Looking back over my own career, as I was involved in managing more and more expensive projects, change programs, and portfolios of businesses, including as engineering manager, managing my own cost center, that a firm grasp of financial tools and techniques greatly enhanced my career. So in detail, you'll be able to use financial information within your organization, get a better understanding of how the finance function within your organization contributes to the business. You'll be able to control a financial system in order to meet your own business objectives and harness the availability of finance, funding if you will, for your organization or for your department or group within that organization. Key point here, you'll be able to understand the business impact of decisions you make on the performance of your projects or your operational areas. You'll be able to communicate effectively with financial specialists. In effect, you'll learn their jargon, you'll understand the purpose of what they're asking and what they're suggesting, and you'll be able to make positive contributions to that. You'll be able to analyze accounting transactions. Yes, you'll be able to read profit and loss statements, as well as balance sheets and cash flow statements. You'll also be able to use a range of different financial controls. But there's more. You see, you'll be able to analyze financial reports with ratios. You'll learn a lot about ratios. Indeed, several of the modules are on that very topic. You'll be able to calculate profit, how you measure it, and how you use that to measure your organizational performance. You'll be able to interpret cash flow, how it's managed, predicted, and how this relates back to projects. You'll be able to use financial information to make those key important decisions. In addition, you'll be able to forecast sales, spending, and other financial factors. You'll be able to apply costing models and tools to calculate break-even points, as well as use different approaches for both budgeting and management. And finally, something you're possibly already slightly familiar with, and that's using investment appraisal techniques for any business cases that you create. So let's make a start. First and foremost, I'm sure you're already aware that all major business decisions are driven by financial information. Indeed, it's often the business case of a new endeavour, an undertaking, which is the driver for that particular project or program. So whether you're involved in launching new products to markets or providing services or, like myself, projects and programs, you'll find that since all of these have financial implications based on key decisions and actions that need to be taken on a daily basis. Indeed, as you go through the modules in this training, you'll realise there was a lot more financial implications going on than you originally thought. Now, I have to agree that finance can seem confusing and often intimidating to those not financially trained. A short story about myself. When I was a project manager in my late 20s, I was lucky enough to be involved in a project which was providing the finance department with financial applications. And the finance director at that time, a very smart lady, said the first thing she wanted to do with me was to get me on a 3-day overview, very similar to this course, I guess. And she knew that once I had a good overview of the jargon and the tools and techniques that were used, that I'd do a better job in managing the project. And that came to be true. So my objective here is to reduce your financial confusion and, most importantly, to improve your ability to make decisions with confidence. And apart from making your business endeavours more successful, due to your wider business understanding, it won't do your future career any harm at all. So in this first module, I'll show you the role of finance within an organisation and its business importance. Let me be clear here, I want to start at the very beginning and assume that you're a complete novice. I'll therefore also give you a very swift overview of the history of how finance developed and to give you familiarity with some of the jargon you'll come across. Oh, by the way, as we go through all of the modules, I'll be adding new bits of jargon, if you will, and explaining what they are and why you should know about them as we go. So let's start off nice and easy with a little bit of history. I hope you've got your handbook in front of you and a pad and paper to make any notes as we go. Just to give a little finance background first, it was in fact 640 BC that the first coins were invented, and here's a picture of those early coins. I imagine this was originally round, and therefore people have traded, bought and sold for thousands of years. The reason why this is important is if you think about the internet, how long has that been around? About 20 years or so, and look how that has advanced and changed all of our lives. But using coins, using money if you will, to trade and buy has been going for far longer. So that will be helpful for you to understand that this is a very mature industry, if I can call it that way, and that a lot of the techniques have taken decades or even hundreds of years to fine-tune to how they are used today. And money, of course, is the means by which other resources, people and infrastructure, can be acquired. Indeed, the invention of money, or more correctly, the evolution of using money, was important because it gives you the ability to store purchasing power. So money is the means by which the consumer, you and I, of other resources can be accelerators or deferred by borrowing or lending. What I mean by that, of course, is that when you've got money, you can gain resources right now rather than waiting for it, or by going to a lender or borrowing the money, again, you can defer how long it takes before you pay it back. Now, the gap between getting money and paying it back is important, and it's why a lot of these financial instruments, such as profit and loss statements, balance sheet, can confuse people because there will be a different point in time from when you make products, when you sell products, when you get paid, or when you pay back loans. So keeping financial records has become much more sophisticated, and figures recorded by hand onto paper before computers became known as bookkeeping for the obvious reasons. Now, an important point here, before the Industrial Revolution, and I'm referring here to the UK, there were just simple trading businesses where investment was more than most individuals or families could raise. In other words, you might own a local bakery, and if you wanted to expand it, you'd have to look to other members of your family to raise money if you wanted to purchase a new building or to expand your current business. And this, of course, was where banks came into the picture. And back in the 1800s, the concepts of many people gaining a share of the business was developed. And what this means is it granted shareholders limited liability with the company, which was set up as a separate legal entity. And this idea of buying shares helped stoke the investment and use of money worldwide. Now, my brief overview wouldn't be complete without talking about fractional reserve and fiat money. There's been a lot of, frankly, bad publicity about banks over the past few decades, the boom and bust and the recent two recessions. Now, banks have got a good side and a bad side, and I suppose the bad side, around the 1930s in America, there was a secret meeting at a place called Jekyll Island where they got rid of the original gold standard and created what is now known as fiat currency. Now, fiat is a Latin term meaning let it become. The idea of fiat currency, nothing to do with the car company, is that a coin, when it's used, its value is defined by law rather than what its market value would be. For example, a gold coin would have a market value. If we were using gold coins, which we don't, then its face value could be worth a lot more than the value of the metal, if you will. So fiat money is based solely on the faith and credit of the economy, which brings me to the second side of this, fractional reserve. You see, fractional reserve banking is the current form of banking practiced in most countries worldwide. You'll be familiar with central banks. In the UK, it's the Bank of England. In the US, it's the Federal Reserve. And without going into the details, what has actually happened is they've abandoned what was known as the gold standard, where a bank would keep only as much money as it had gold, so that if there was a call on its reserve by those who have invested money or saved the money in the bank, they knew they could give it back. But fractional reserve means that, broadly speaking, that a bank can loan up to 10 times more than it actually has in gold. But it does get even worse. You see, every time someone takes out a loan in a bank, on the bank's computers, it creates that extra money, so that the result of everyone taking out loans, new money is put into the system. You see, what the bank is allowed to do is to create money to be able to loan it out to others. You see, just like the Bank of England or the Federal Reserve in the USA, it is they who print the money. So when anyone takes out a loan, let's say for £10,000, the bank creates £10,000 on its computers, not in real money, and that is what you will have to draw upon the bank and use that £10,000 to buy whatever it is you want. And that continues and continues. So this works when a bank accepts deposits from you, an investor, let's say. When they make loan or investments, the bank holds reserves equal to only a fraction of its deposit liabilities, providing immediately liquidity to depositors, in other words, around 10%. So while gold or silver-backed commodity money, or representative money as it's called, entails legal requirements that the bank of issue redeem it in fixed weights of gold and silver, that's not true for the money on their computers. You see, fiat money is currency that a government has declared to be legal tender, and fiat money's value is unrelated to the value of any physical quantity. So referring to the UK, money that banks create isn't paper money that bears the logo of the government-owned Bank of England or the Federal Reserve, the dollar in the USA. It's just the electronic deposit money that flashes up on the screen when you check your balance at an ATM. Now, I'm introducing you to these concepts first before we get into the finance itself, so it'll make a lot more sense when we look at interest-bearing accounts, when we look at paying interest, tax, paying liabilities and assets. So the numbers you see when you check your account, usually online these days, the balance, they're just accounting entries in the bank's computers. These numbers are a liability, or put more simply, an IOU from your bank to you. No real money is there, it's merely an IOU. So by creating these electronic IOUs, banks can effectively create a substitute for money, which they've done very successfully. It's no accident that banks are usually the tallest and grandest, most expensive buildings in any town or city. So by using your credit card or using internet banking, you can spend these IOUs as though they were same as in the UK £10 notes or $10 in the USA, for example. So when a bank makes a loan, it does not issue thousands of pounds worth of banknotes. Instead, it only credits your bank account with a bank deposit of the size of, say, a mortgage, if that's what you were getting a loan for. And let's face it, most of us on a personal basis is often things like cars or a mortgage or a home loan, if you will. And at the moment when a bank makes a loan, new money is created. And it uses the logical rule of supply and demand. The more money that gets created, the less the pound or the dollar or the yen in your pocket is worth. So you see, inflation is not down to people raising their prices. It's merely as more money is created, each pound becomes worth slightly less. And that amount is called inflation. So here's my last piece on the bad boys, the banks. Then I'll get back on their side and tell you how important they are to us doing business today. So by creating money, banks have increased the amount of money in the economy by an average of 11.5% a year over the last 40 years. And as a consequence, bank deposits make up over 97% of all the money in the economy. Only 3% of that money is still in the old-fashioned form of cash that you can touch, coins and notes. So that said, let's now see how finance and banks and loans and liabilities are all wrapped up together. So what is finance? Well, typical questions are, what is the role of finance within an organisation? Yours, for example. And why does it appear to have a special status? And how does finance department interface with other departments within your organisation? And equally valid, what exactly is the difference between financial accounting and management accounting? Well, I'm about to tell you. But just before I do, let me remind you that once you move into a management role, you will be expected to have an understanding of the financial performance of your department, group, your team, your part of the organisation. And almost certainly at some point, you'll need to participate in strategic decisions, which absolutely require an appreciation of the financial implications of different courses of action you might choose to take. And frankly, finance is far too important to leave solely to the finance department, which is why you need to become financially literate. Now, like most professions, finance has a culture of describing how they do things. And as you learnt, they've been around for hundreds and thousands of years. And it's Robert Grant who quoted that finance is a set of beliefs, values, and behavioural norms among the members of an organisation that influence how they think and behave. Sounds very grand, doesn't it? Now, different departments, different organisations may have different views about what is needed to guarantee the success of an organisation. They might see that an organisation needs to be successful down to its skills of its people, aptitude, belief systems, first-class training, and in the case of finance, for sure, having professional bodies' codes of conduct. It's equally valid in my profession, and that is of project and program management. So judgment is the most important aspect of financial decisions, and you need to increase your understanding of the financial tools and jargon so that you'll be able to add your unique value to those decisions. And believe me, it only takes a few situations like that, and you will certainly start to get noticed. So there are two main branches within finance, as I've said, financial accounting and management accounting. So let's just touch on those now. And the best way to understand that is to show the differences. Starting with financial accounting, well, the focus of that is on external reporting, whereas management accounting is an internal focus. So if you pick up the Financial Times or look at financial information on the internet, you'll be looking at companies' financial accounts, not their management accounting. Financial accounting records the past. Up to this point, this is how they've done. And as you might guess, management accounting is saying, okay, but let's look into the future based on what we've done in the past, predicting or estimating to the financial future of our organisation. Financial accounting is a legal requirement, and quite right too, whereas management accounting is the choice of the organisation. It's how much you need. It's what tools and techniques and how much you apply it. Different industries will have different requirements here. Financial accounting focuses on rules and regulations, whereas management accounting is more flexible. which is why the techniques and tools you'd use in management accounting are so various, because different organisations will have different needs. Financial accounting keeps the score because, of course, it's recording on the past, it's how we've done thus far, and you've guessed it, management accounting adds value by predicting the future, allowing us to make timely decisions on if we don't like what the future looks like, to do something about it now and change the future. Financial accounting looks at the whole business, whereas management accounting may only look at different parts or segments of the business, so that when I was engineering manager, I would be interested only in managing that particular cost centre. Financial reporting reports to fixed timescales, typically quarters and fiscal years, which are often not the same as January to December. When I last worked for a US multinational, the beginning of their financial year was June the 1st, whereas management accounting is consulted frequently, because management accounting is often based on particular endeavours, which could happen any time of the year, and if you're managing an operational part of the organisation, then that would be an ongoing activity. And finally, financial accounting protects the shareholders or the stakeholders of an entity, whereas management accounting helps the manager to do a better job and for their part in the whole organisation to be more successful. So, both financial and management accounting rely on accurate and timely data to work effectively. I guess that's obvious. But they do have different objectives, as you've just seen, and a different emphasis. The accurate recording of transactions, the preparation of financial reports that are required by statutory and regulatory authorities all fall, however, within financial accounting. Good, well that brings us to the end of Module 1, a very general overview. So you and I will meet again in Module 2, when I'll start to introduce you to some of that financial terminology. So bye for now.